Hi, my name's Joshua Mahony, Chief Market Analyst at Scope Markets. Let's look at the week ahead for the week starting Monday, the 22nd of April. Plenty to sink our teeth into as we see a market that has been very volatile on a number of reasons. We've, of course, got earnings season that is underway at the moment. We've got the whole Israel-Iran factor. We've got the constant pushback on expectations for Federal Reserve interest rate cuts. And so once again, it's going to be inflation that dominates. It's going to be central bank thinking that dominates. The Federal Reserve now in their lockdown period for this week. So we won't be seeing any commentary from the Fed. But we do have the BOJ reporting. So there's going to be a big focus on the Japanese yen once again. In terms of the sort of overview, the big picture outlook here, we've got a number of key events to be looking out for. Tuesday, we have some PMI numbers coming out of the Eurozone. We've got inflation overnight out of Australia. Again, Germany back in view with the EFO business climate number. Core durable goods also out of the US. Again, Germany on Thursday with the consumer confidence reading. We've got the GDP number from the US on Thursday. On Friday, we wrap things up with the BOJ rate decision and that all-important core PCE price index inflation gauge out of the US. We're going to kick things off first and foremost with a focus on Australia, though. We have, of course, like I said, got that inflation gauge coming out overnight. And what's notable here, and you can see it, is that the main inflation readings that we follow are quarterly. When it comes to Australia, the same kind of thing when it comes to New Zealand. So we have to wait a little bit longer, and there can be greater volatility when we do see those numbers reported. Well, what's expected this time around? The quarterly figures expected to rise up to 0.7%. Of course, if you annualize that out, if that's 1 quarter, then it's, of course, above target, but not necessarily too much. If it's at 0.5 or below, then you're looking for a potential move back down to 2%. So things are relatively moving in the right direction, albeit that they're moving in a direction that's slightly above target. So certainly that's going to be the key one to watch out for. On Tuesday, we've also got manufacturing services and composite readings. As you can see, it's manufacturing that's the big concern for the Australian economy. But the composite number does highlight just how strong that services sector is and how it's dragging the sort of wider Australian economy upwards. And then on Friday, we've got inflation back in play with the PPI number forecast to drop down to 0.6%. So again, that could provide some respite to the idea that, like we're seeing with the US, that we may not necessarily see any rate cuts coming into the fore from the Bank of Australia anytime soon. I'm just going to quickly grab up their forecasts for the Bank of Australia, or sorry, the RBA. And the expectation as things stand is the first rate cut will come in November. So that would be essentially just one rate cut currently priced for this year. So will those expectations change around this inflation? Well, certainly I think there's a good chance of it if we were to see a significant downside move in terms of inflation. And so certainly something to look out for. I saw something recently talking about the housing market over in Australia and the high percentage of homeowners that are on flexible mortgages. So they will want to drive down that cost of borrowing as quickly as they can. And so that's going to be something that's key to be watching out for. In terms of a market that I wanted to track on this one, I just wanted to bring up the Australian dollar against the Japanese yen. Let me just go full screen here so you can see greater detail. So from a wider perspective, here's the weekly time frame. So you can see since the lows in 2020, we have been within a very clear and pronounced uptrend. So that's your primary trend. In terms of near-term price action, you can see this flush lower that has taken shape on today, which is Friday. But we've regained some of that ground. Now, the question mark here is whether we're going to see, on one side of it, the Australian inflation number that points towards the potential for more rate cuts, currently just pricing one rate cut for this year. Would we see more? Well, certainly if we were to see a below expectations reading on that quarterly metric, it could lift hopes for further rate cuts from the RBA. In terms of what's happening with Japan, well, that's going to really come into the forefront over the week as well, because we have got the the Bank of Japan rate decision coming out. So here it is on the 4 hour. So we've seen on the daily time frame, we've got a very clear trend in play. We've flushed below that swing low. So you could say that we're now no longer creating higher lows. But if you look, it does bear striking similarity to what we've got here, right? So we did break through that swing low, but we didn't sustain that price action. And crucially, we then broke up towards the upside. So if you're looking at that low here, it was on the 1st of February. Let's just go into it and see exactly how that played out. So here we go. So we've seen that breakdown. It actually sustained and we saw close where we haven't seen that here. It's very swift move, the one that we've seen here. And ultimately, it was the breakup through your sort of initial swing highs on that we had been seeing on the way down. That breakup through that level, let's just see it on the hourly time frame. The breakup through that level would have been the sort of signal to say that essentially we are going to continue that bullish trajectory once again. And we saw that recovery straight from there. So how do we sort of determine whether this is going to be indicative of a bearish turnaround or not? Well, really, it's about whether we can sustain a breakdown through that swing low, which is 98,175. If we can, then yes, maybe this is a near-term top. And certainly the devaluation of the yen has drawn comments from a number of members from the Bank of Japan about the possibility for them to intervene to try and strengthen the Japanese yen. But by and large, it does make them competitive on a sort of global perspective for Japanese exporters. So it's not all bad, the devaluation of the Japanese yen. So the key thing to be looking out for here is, let's go back to that 4-hour chart. We can see here on the near term, we've got this sort of stepped move lower where we've got the creation of lower highs time and time again. So if we see a breakup through 99,586, that's going to give me greater confidence that this move low and that brief move below support is temporary in nature and that we are going to continue that bullish trajectory. Otherwise, like I said, if we do break back below that 98,175 mark, there is a possibility things turn around. But certainly inflation data out of Australia and that Bank of Japan interest rate decision, that's going to be really key in determining exactly which way we go for this currency pair. Next, let's look at the likes of Japan anyway, because we're talking about that topic. And you can see once again, we've got the likes of the manufacturing PMIs, services, composites. So PMI day on Tuesday, very clearly defined. Once again, it's manufacturing that continues to struggle, but an expectation that we do see some improvement on that front with 48.9. So gradually trying to move back up towards that expansion territory figure of 50 and above. But the key thing is really on Friday, we've got Tokyo inflation. Now, bear in mind, Tokyo inflation is a leading indicator of what's going to happen on a national front. And so generally it will tell you, we're looking at April data here, right? So the nationwide or the national figures generally will be more lagging. So this is going to be a key indicator of where we're going. And you can see the expectation is a move towards the downside. We've got that interest rate decision from the Bank of Japan. They have moved out of negative rates, but now they're at 0%. The expectation is they're going to keep it steady as is. But, with some of the commentary coming out around the possible intervention to try and prop up the Japanese yen, there is a question mark about whether they might want to lay the framework for potential future interest rate hikes going forward. And of course, that would stand them in stark contrast to some of the other central banks that are trying to move things in the opposite direction. In terms of the outlook for this year, that's what's really interesting because bear in mind, we're not really looking at a central bank that moves things from a 25 basis point perspective. It's a little bit more moderate over there. Nonetheless, there's an expectation that this year we will see 2 rate hikes currently priced by London Stock Exchange Group's Reuters Icon platform. 2 rate hikes of 10 basis point by December. The first rate hike is currently priced in for July, so not too far away. And the second one is priced in roughly around October or December. So 2 hikes by the end of the year. So that sort of relatively hawkish tone could provide some bullish sentiment for the likes of the Japanese yen. So keep an eye out for that. And certainly, I've highlighted that within the likes of the Aussie against the yen. In terms of the market that I wanted to bring out for you here for the Japanese market, I just wanted to bring up the likes of the Nikkei 225. Now, the Nikkei has been a massive outperformer over the course of the past year. And certainly we're looking at a market that has seen a relatively protracted pullback or a strong pullback over the last month that really flies in the face of the rampant bull market that has been in play. So people will be looking up for potential signs of further downside, yes, but also signs for them to be able to get back into what has been a very bullish trade. Now, you can actually see that this sort of pullback that we're looking at here could be a sort of retracement here. So let's just get a deep Fibonacci onto this and see where we are. So we've come into that 76.4 fib and seemingly respected it very well thus far, very tentatively moved beyond it. Let me just get rid of the 61.8, moved tentatively beyond it, but not very far. And we've rallied up from there. So is this the sign that we could see a bottom for this market? Well, let's just get a trend line on the top end to see the sort of current trajectory. You can see that the trend still does remain bearish over the sort of intraday charts. And so we just really want to start setting alerts or keeping an eye out for this same area. I mean, you can see it drawn on here, which highlights the fact that 38268 roughly is around the neckline. Let me just try and get it absolutely perfectly. The neckline on this, essentially a double top formation that we're looking at here. So what was support turned into resistance. That resistance is the near-term swing high. So yes, we're regaining ground as we head into the weekend, but there's a good chance that we do roll over once again. And certainly if we see that more hawkish tone from the Bank of Japan, perhaps that could stifle these gains. But if we break up through this sort of 38300 kind of area with this swing high alongside that neckline of the double top formation, that could be the signal that we're back in a bullish mindset for this market. And what has been, the big outperformer over the sort of final quarter of 2023 and the beginning of 2024. This was the really positive story within markets, and Nikkei just kept pushing higher and higher and higher. We've seen a big pullback thus far, 76.4 fib holding up as things stand. Let's look out for whether the trendline resistance plays out once again, or whether we see a breakup through 38301 to signal exactly where we go from here for the Nikkei 225. And finally, I just wanted to bring up the final area that we're looking at, and that is the US economy. Of course, the big headline really is going to come on Friday. That is the core PCE price index, which is the Federal Reserve's favored inflation metric. Keep a very close eye out on that, because as things stand, the inflation that we've been seeing over recent months that have been reported essentially keeps pushing back those expectations for a rate cut from the Federal Reserve. So this could do the same thing, or perhaps it doesn't. Perhaps it breaks that trend and starts pointing towards a potential reason for the Federal Reserve to be a little bit more dovish. But as things stand, we've gone from expecting 7 rate cuts, or the market expecting 7 rate cuts this year, which always seemed a little bit foolhardy, to 3 rate cuts. And the Federal Reserve even priced that in themselves when they looked at it in the dot plot. That's what the majority or the median voting members within the FOMC had opted for. They looked for 3 rate cuts this year. Now we're seeing the likes of Kashkari coming out and saying he thinks maybe we don't get any rate cuts this year. So that core PCE price index is going to be absolutely key within that. And then alongside that, we've got the likes of the GDP figure. That's going to be a revision after the preliminary number that we had seen previously. Of course, Tuesdays, we've got PMI day. We've got the core durable goods numbers on Wednesday. So plenty for US dollar and US equity traders to sink their teeth into. And with that in mind, and with the sell-off that we have been seeing in mind, let's just close things out by looking at US indices, because I often look for markets that are very clear cut in terms of their trend. And that has been the case for a long period of time now. You can see on this weekly time frame that since the lows in sort of mid to late October, the weekly declines have been absolutely minimal. You can see there's one significant decline here, another smaller one here, and that's pretty much it from October all the way through to the end of March, basically. And now we're looking like we're going to close out a third one, which unfortunately keeps increasing in size. And that's not necessarily a great sign. I would say that the week ahead is going to be a key one from a number of perspectives. And part of that is inflation, as I highlighted, but also part of it is going to be earnings. We have seen some question marks around whether tech is going to be sustaining its or able to sustain its growth rate. Well, we have got the likes of Meta, the likes of Alphabet and Microsoft, whole host of big tech names reporting over the course of next week, Tesla as well, I believe. And so that could provide the basis for a bullish rebound for this market. You can see this breakdown through trendline support. That was your first signal. The second signal that we potentially had topped out for the time being came with a breakdown through your swing low at 5103. And then it's a question mark of, where's the bottom within this, right? And so if we're looking for this to be a retracement, you can say, well, it could be a retracement of this entire move. But that would essentially call for a potential sort of wider pullback into, let's just grab this fib and put on some of these deeper more shallow levels. Let's just get all of them on. So we've gone into the 23.6, found some support from here. 38.2 still is a pretty significant decline from here, and certainly the deep declines are way away from where we are at the moment. I mean, look, it seems like for the time being, the Iran-Israel thing could be cleared up with the Israeli attack doing little to make us believe that we're going to see another response from Iran. So that could be some good news. If the tech stocks come out with good numbers, that could be a potential reason for us to start regaining ground once again. And then, of course, we've got the likes of the core PCE in particular to really tell a story on the inflation perspective and highlight how things are going to play out in terms of monetary policy. In terms of the trajectory of this market and where we're going to bottom, I would say that this kind of view probably isn't going to help us too much, because we don't know necessarily, is it going to hit, a shallow retracement, a mid-sized retracement, deep retracement. It makes more sense to play this on a short term, on an intraday basis. And I would say that this 4-hour chart, and let's see exactly on the hourly, 4-hour or hourly, both give us a very good idea of a market that has been very consistent within its moves, each time providing us with nice deep retracements. I would say that pretty much every single one of these initial retracements were 76.4 fibs. So plenty of good entries. Then more recently into this shallow retracement. Now we're rallying up into the weekend. The question mark is, do we see the same once again? Are we seeing another shallow retracement? We've gone through the 61.8 and we're starting to flounder a little bit. The stochastics looking like we could roll over, currently crossing. The key thing here is, do we break the 50-57 mark? If we do, then it looks like we could be moving into a more positive mindset for this market and potentially having bottomed out. And so instead of saying, we're going to bottom at this level or that level or that level and guessing, essentially, it's just a case of saying, is this intraday trend continuing to play out? And as things stand, it is. But if we do see a breakup through that 50-57 swing high, then that could be the first tentative sign that this market could have bottomed out. We haven't seen it quite yet, but hopefully this coming week could provide us with that. Until we see that, the downtrend does continue to hold here for the S&P 500 as people continue to remain concerned over the potential trajectory of interest rates in the US. We've seen high retail sales at 4%. We've seen elevated growth. We've seen the likes of inflation continuing to remain strong. The jobs numbers are still relatively strong. There's not really too much reason for the Federal Reserve to cut right now. And so really what we need, or markets and bulls need, is something to tell us that maybe we will see a justification for a rate cut this year, 1 or 2, who knows. But the core PC price index number could be exactly that. So keep a close eye out for that in particular. But like I said, there's a whole host of US data points coming out, the likes of the PMIs and the core durable goods and alike. So another busy week on the earnings front and on the economic front. Plenty for traders to sink their teeth into. If you want a look ahead for the earnings data and releases, I have provided a preview, so make sure to check out the Scope Markets YouTube channel for that. I hope this has been useful. Have a great weekend and have a good week ahead. Thanks a lot. My name's Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day.